Ladies and gentlemen, buckle up, because what is unfolding right now is not just another market cycle, not just another rally in gold and silver, and definitely not business as usual. We are only days into 2026, and already the world feels like it's cracking at the seams. Geopolitical shocks are rippling through global markets. Currencies are losing credibility faster than politicians lose promises. And beneath all the noise, something far more dangerous is being exposed: the illusion of stability. For decades, we were told inflation was temporary, debt didn't matter, and fiat currency was backed by trust. But trust doesn't buy groceries, and it doesn't protect savings. While most people are distracted by headlines and stock market swings, smart money has been quietly positioning for what comes next. Gold is surging toward historic territory. Silver is breaking free from levels it was trapped under for years. And suddenly, predictions that once sounded insane, gold at $6,000, silver at $100, are no longer fringe ideas whispered on the internet. They are being discussed openly by veteran traders, central banks, and institutions that once mocked precious metals. That alone should make you pause. Because when the same system that told you metals were useless suddenly tells you they're essential, it's not generosity, it's desperation. This is not about hype, fear, or chasing prices. This is about understanding why the rules of the game are changing right in front of us. In this video, we are going to peel back the layers of what may be the biggest financial con game in modern history. How fiat money lost its anchor, why debt and inflation are mathematically impossible to control, and why gold and silver aren't going up so much as paper money is quietly going down. This is about context, not clicks, about preparation, not panic. And by the end, you'll understand why 2026 could be the year everything finally breaks into the open, and why those who see it early want to be asking what happened, but what to do next. Uncomfortable truth most people still refuse to face. Gold and silver are not rising because they are suddenly more valuable. They are rising because the measuring stick itself is breaking. For decades, fiat currency has been sold to the public as stable, flexible, and safe. In reality, it has been quietly diluted year after year through debt expansion, money printing, and financial engineering that benefits governments and banks at the expense of savers. Every crisis was met with more liquidity. Every slowdown was met with lower rates. And every consequence was postponed by creating even more currency out of thin air. This worked as long as confidence held. But confidence is not infinite. When people finally realize that their purchasing power is shrinking faster than their wages can grow, they don't panic all at once. First, they ignore it, then they rationalize it, and finally they rush for the exits. That is where we are now. Gold and silver are not speculative assets in this environment. They are mirrors reflecting the damage already done to the system. When gold threatens $6,000 and silver talks of $100, it is in around T. Because metals are extreme, it is because the currency used to price them has been pushed to an extreme. This is the core of the con game, telling the public that inflation is manageable, debt is serviceable, and the system is under control, while insiders hedge with real assets. Once you understand this, the entire narrative flips. Metals are not the risky bet. Believing paper promises forever is debt trap that makes these price targets not just possible, but mathematically inevitable. The global financial system is now built entirely on borrowed time and borrowed money. Governments no longer pay down debt. They roll it forward, refinance it, and expand it. The United States alone carries debt so large that it cannot be repaid without destroying the economy, which means it must be inflated away. This is where gold and silver enter the picture. Inflation is not a policy mistake anymore, it is a policy requirement. Without constant currency expansion, the system collapses under its own weight. Central banks understand this, which is why they continue to buy gold at record levels while publicly downplaying its importance. They know that hard assets are the only escape valve in a debt-based system. Silver, meanwhile, sits at the crossroads of monetary history and modern industry. It is consumed, not just stored. It disappears into solar panels, electronics, medical equipment, and military technology, shrinking available supply every year. When debt expansion collides with real-world scarcity, prices don't move smoothly, they gap higher. The reason silver lags for so long is the same reason it explodes so violently. It is small, thinly traded, and structurally short. Once the debt-driven inflation narrative breaks into public awareness, silver doesn't need new demand. It needs recognition. And recognition in a system this leveraged comes suddenly and without mercy. Mechanics of the con itself, how paper pricing replaced physical reality and kept metals artificially cheap for decades. Gold and silver are not priced primarily by people buying bars and coins. They are priced by derivative contracts traded on futures exchanges where almost no one intends to take delivery. For every real ounce of silver, there are dozens, sometimes hundreds, of paper claims attached to it. The system works only as long as confidence holds, and most participants stay in cash settlement mode. The moment too many players demand real metal, the illusion breaks. That is why price suppression always looks calm until it doesn't. It's also why sudden vertical moves feel shocking to the public but obvious in hindsight. The banks rely on leverage, speed, and complexity to control perception, not supply. But physical metal doesn't care about narratives or algorithms. When inventories drain and delivery pressure rises, futures markets lose authority. That's when price discovery migrates from paper screens to vault doors. China and other Eastern markets already understand this, which is why physical settlement and long-term accumulation dominate there. The West, by contrast, has been trained to trust paper promises. Chapter 3 makes one thing clear. The $6,000 gold and $100 silver targets are not predictions pulled from thin air. They are what happens when paper control fails and physical scarcity finally sets the price. Focus from theory to consequence, because once the paper illusion breaks, the impact is not limited to metals. It ripples through everything. A repricing of gold to $6,000 and silver to $100 is not about metals becoming expensive. It's about currencies being exposed as weak. When that happens, purchasing power collapses quietly but relentlessly. Savings lose meaning, wages lag behind prices, and debt becomes the only thing growing faster than inflation. This is why central banks are hoarding gold at record pace. They are not speculating, they are insulating themselves from a system they know cannot be fixed. The public is always late to this realization, because trust decays slowly, then all at once. That's when behavior changes. People stop asking what an asset yields and start asking whether it will still exist tomorrow. Gold and silver answer that question in a way no paper asset can. Chapter 4 makes clear that the coming move is not a spike, it's a reset. Once metals are repriced higher, they do not return to old ranges, just like housing, energy, or food never returns to pre-crisis pricing. The danger is not volatility. The danger is being positioned entirely inside a system that must devalue to survive. When confidence breaks, capital doesn't rotate politely, it flees. And it always flees toward assets with no counterparty risk. That is the real reason 2026 matters. This isn't about timing the top. It's about recognizing that the rules governing money itself are changing, whether people are ready for it or not. The final layer of the con game, psychology, the system does not collapse because people suddenly discover math. It collapses when belief breaks. For decades, investors were trained to trust benchmarks, trust experts, trust official inflation numbers, and trust that markets are fair. That trust is now cracking. When respected institutions suddenly flip from dismissing metals to projecting extreme upside, it isn't generosity, it's damage control. By the time targets like $6,000 gold or $100 silver are spoken publicly, the quiet accumulation phase is already over. At that stage, the game shifts from positioning to survival. This is where most people make their worst mistakes, chasing headlines instead of understanding structure. They buy emotionally, sell in panic, and never ask why volatility exists in the first place. Chapter 5 explains that volatility is not random. It is a weapon. It is designed to shake out weak hands while transferring assets to those who planned early. The people who benefit most from monetary resets are not the loudest voices on television. They are the ones who prepared quietly, held through uncertainty, and understood that real wealth protection is boring, patient, and often uncomfortable. This chapter makes one thing clear. Precious metals are not a get-rich-quick trade. They are an exit from a rigged system. Those who treat them like a lottery ticket will be punished by the same system they're retrying to escape. But those who understand why gold and silver have survived every currency experiment in history want to be shocked by what comes next. They'll recognize it. And recognition, not prediction, is what separates preparation from regret. Understand this clearly. What's unfolding isn't a surprise, it's a reveal. The numbers didn't suddenly break, the system did. Gold moving toward $6,000 and silver toward $100 isn't about speculation or hype, it's about the slow, irreversible loss of trust in paper promises. Every empire that debased its currency followed the same path. And every time, hard assets didn't rise because they became more valuable, they rose because everything else became less honest. This isn't a call to panic, and it's not a call to chase prices. It's a call to think differently. The real danger isn't volatility in metals, it's stability in a system built on debt, leverage, and denial. By the time the majority feels safe again, the reset will already be complete. History rewards those who prepare before consensus arrives, not after headlines turn bullish. Whether you agree with every prediction or not, the direction of the risk is clear. The con game only works as long as people believe in it. When belief breaks, reality takes over. The question isn't whether change is coming, it's whether you'll recognize it in time or look back and wish you had.
Hello friend, welcome to my YouTube channel. I hope all if you are doing great and having an amazing day. My name is Noor Baqi and I am really excited to start this new journey with all if you. You know, this channel is not just about videos, it is about story and ideas and inspiration. I created this channel to sharing something positive every signal week. Sometimes we all need little motivation, and sometimes we just need a good story to smile again. Decide exactly what this channel is all about. You find understanding stories, real life experience, and powerful lessons that again change the way you think. I be uploading new videos regularly, so if you don't want to miss any of them, make sure to subscribe to my YouTube channel and press this bell icon so you get notification when you post something new. You support means everything to me, and to great we can build a community full of partnership, learning, and good vibes. So sit back, relax, and let us begin this amazing journey together. Thank you so much for watching and welcome once again.